All right, let's talk about protecting your investment assets. And then next we're gonna talk about protecting your retirement accounts. So when you wanna protect your investment assets, we wanna think about, is this an asset that is liability producing or not? So when we have our trifecta here, okay, we got our W-2 or our business income over here. Again, you might have an entity there, you might not. We've got us individually down here, and then we have our trust. This is our trust too. Now, your investments are going to be over on this side of the trifecta, and we're going to use an LLC typically for investment assets. Now, if this is a liability producing asset, I want to use an LLC. A liability producing asset, the most common one out there for people is rental real estate. Okay, I have 5 or 6 LLCs that own rental real estate, and they're all owned in a separate LLC because they have a certain amount of equity in them. Now, think of the other assets that you might have that are not liability producing. Maybe you have a brokerage account, okay? Well, this has value to it, just like the real estate has equity and value in it, the rental property, but does it produce liability? How am I gonna get sued in my brokerage account? Right? You're just not going to get sued there. There's not like a tenant or a contractor or someone there where you get sued because your brokerage account did something. In the rental real estate scenario though, I can get sued because something happened at the rental property. So I want to isolate that risk with an LLC. Now, if a tenant slips and falls or a contractor has an issue and gets hurt on the job, they're forced to sue the LLC, okay? They can't sue me. They get stuck right here at the LLC. They can't come down here. Nope. They can't come over here. Nope. Can't get over to the brokerage account. The LLC is kind of containing the liability at the LLC level. Do I use an LLC for a brokerage account? You could. You could use what's called a COPE or charging order protection entity. I'm going to come to that last here today, but it's possible to do that. If you have millions of dollars of net worth, we would implement that strategy. If you've got hundreds of thousands of net worth, I'm not going to do that. We're going to not put any entity around your brokerage account because the account itself doesn't create liability. So we're going to put LLCs around assets that create liability. Your rental properties, your small business or big business or side hustle, that could create liability. We want an entity around that. This is either an LLC or an S Corp, which is, again, if something happens in that spot, in that business, the liability is contained in that entity. They can't come over here. They can't get into your brokerage account. They can't come after your home. Think of LLCs when you're thinking of asset protection and investment assets. Now, what if I have multiple properties and rental properties? Do I hold them in the same LLC? Definitely not. And I should say it depends, not definitely not. You might, but we generally want to look at using multiple LLCs for multiple properties as long as you have enough equity in them. So let's come back here to your rental property. I've got my LLC, right? This is you down here again with your trust. Now, let's say I own 3 properties. Okay, that's 3 houses that are owned by one LLC. Let's say that each property has $200K of equity. So I've got $600,000 worth of equity there. Let's say a tenant slips and falls on property number 1 and they want to sue you. Well, they can't sue you because you don't own the property. So they have to sue the LLC. Well, when they sue the LLC, they can get at any assets the LLC owns. If I got a bank account with some money in there, they can get at any of the cash in the LLC checking account. What if I had paid that cash down to myself personally? Can they get it? Nope. We don't want to leave cash past a little bit of operating cash sitting in your LLC bank accounts that hold rental properties. Leave enough in there to cover expenses and to operate it, but don't accumulate all the cash and let it sit there because it become a risk for a lawsuit. The second problem I have after leaving cash in the bank account, let's say you didn't do that. You were good. You only left operating cash. The other problem and concern I have here is we had a lawsuit on property number 1. I've got the $200,000 of equity in that property at risk, but also the $200,000, the other $400,000 from those 2 properties that had nothing to do with the lawsuit. They're owned by the same LLC, so that creditor can go after those properties and that equity. So now I've got $600K of equity at risk from one property. Now, I don't love that, right? We don't like having all our eggs in one basket, so to speak. So how do I solve for that? How do I fix that? Well, you can do multiple LLCs. So I might have one LLC that owns one property, another LLC that owns the second, and another LLC that owns the third. And those are each owned by me, right? Or my trust. And we could have this scenario here. Now, if something happens on property number 1, there's a lawsuit. Well, they're forced to sue LLC number 1 and they're stuck there. They can't come down down to me. They can't get after this LLC and that property or that LLC and that property. They're all protected separately. So by using separate entities and separate LLCs, I get separate liability protection. So the benefit here is I get greater asset protection by using more LLCs. The downside, of course, is there's more cost. There's more work here to have multiple LLCs than to just have multiple properties in one. So when does it make sense to use multiple LLCs versus putting them just in one? Our rule of thumb is not about how many properties are we looking at, it's how much equity is there between the different properties. So for example, in that one I gave earlier where we had 3 properties, each of them having 200,000 of equity, I would probably do a separate LLC for each of those properties. We like to say every 200,000 of equity, you should set up a separate LLC. So for example, let's say you had 10 properties all in one LLC and each property had $10,000 of equity. Well, I'd actually put all of those properties in that same LLC because I've only got 100,000 of equity to protect. If something went wrong on property number 8 out of the 10, they're forced to sue the LLC. They can't get after me, my other 9 properties. $10,000 at risk, no lawyer's gonna chase that down. So if you have properties that are highly leveraged or you're always stripping out the equity, you could have more of those in the same LLC and I would be fine with that. And we've had that. I've had clients that have over 100 properties in one LLC and it drives me bonkers. On the other hand, let's say you had 10 properties and each of them had 200,000 of equity. You might have 10 separate LLCs. That amount of equity at being at risk and putting all the eggs in one basket might not be worth it. Now, of course, we're going to do multifamily properties in their separate LLCs. Commercial properties are always in separate LLCs like office or retail. Where we're grouping these and we may put them in the same LLC if there's just smaller amounts of equity is typically the single family rentals. So that's what I'm kind of depicting here as we're breaking these out. Now we have another option. There are some states that allow for what is called a series LLC, which allows you to have separate asset protection treatment on different properties, but one LLC with the state. This is called a series LLC. Okay, now when you have a series LLC, what you do is you file one LLC with the state. It's called a series LLC. 20 plus states have a series LLC. Texas, Nevada, Illinois, Utah, Tennessee. I'm just thinking of a lot of states we set them up at. There's over 20 states that now have a series LLC. But if you have properties in those states where series LLCs exist, what you can do is file one LLC with the state. Illinois has it too, by the way. And then you create these baby or sub-series LLCs, not filed with the state. They're created internally with a one-page document that's just an exhibit. Each of those subseries is going to own a separate property. So now I've only got one LLC to maintain at the state level, but I get separate liability treatment by using this subseries method that is going to own the separate properties. Now if something happens on property number 1, there's a lawsuit, they're stuck in this little subseries. They can't come over to 2 or to 3, down to the series. They can't come after me personally because I own this thing, right? They're stuck at that little subseries. So that's the series LLC. So for those of you that have multiple rental properties, particularly single family, or you got a large portfolio, a series LLC is a great solution for you. It's a little more complicated to set up because it requires these exhibits than a regular LLC, but it's a lot better than just setting up tons of LLCs. Now, the nice thing with this series, and we have some clients that have over 100 subseries, is it's unlimited how many subseries you can use. So you can build on this structure over time with your one series LLC, but separate subs. Now, there's a couple caveats with this. You are required to have a separate bank account and titling of this property in Series 1, Series 2, Series 3. So if you called your LLC, your series ABC Investments LLC, this subseries would be Series 1 of ABC Investments LLC, or whatever you want to call it. You could call it, if the property's on Green Street, it could be the Green Street series of ABC Investment LLC. That is a separate entity in and of itself. It will have a separate bank account to receive the income and pay the expenses, and you need to title your leases and the property into that subseries name. So there is some work on the subseries where you do need to keep a separate bank account if you want the separate liability treatment, and you do need to title and treat it like it's a separate entity. But it's not an additional filing to the state. All right, now that is the series LLC. Again, there's 20 plus states that have it. If you have multiple rental properties, a larger real estate portfolio, I would definitely look at the series LLC, and our lawyers at KQS Lawyers are setting those up every day for clients across the country.
We have a couple questions. One's a little bit of a comment. Randall Cotner on YouTube said, how are the series LLCs holding up in court, Matt?
The series LLCs hold up in court very well. because they're in law. So this is not like some concept or some structure that some lawyers tried to create or some loophole or something. Like the law specifically says what I just told you in these states that have a series LLC. Like the whole purpose of them was to get that separate liability treatment for people that wanted to utilize this. And so the states that have adopted these have affirmatively said, we don't want to make our citizens in our state have to set up all these entities to contain their risk and liability. Let's let them use this series structure. And so it's like in the law, like a judge does not have a choice except to apply the law. Now, there's another group of thought of people that does not include our law firm and not me as a lawyer that says, hey, let's use these series LLCs in other states. So for example, I'll set up a Utah series LLC or a Delaware series LLC or a Nevada or a Wyoming series LLC, because all those states have series LLCs. But I'm going to take that Wyoming series LLC and I'm going to register it foreign into Arizona, a state that does not have series LLCs. Or I'll register it into California, a state that does not have series LLCs in their law. And I'm going to argue that the state of Arizona, if I have a lawsuit and I've used this series structure, must honor the corporate structure from the state where I created the LLC. Now, there's some decent arguments about that. There are lawyers that make that argument and lawyers who use that structure in other states. Not us. We don't believe that, and I haven't seen cases affirmatively giving that protection in states that don't have a series LLC law, so we're a little suspect on it ourselves. There might be some pioneering case that breaks that through in certain states, but we're not aware of it, so we don't use the series LLC structure outside of states that don't have it automatically in the books on the laws.
We got another one. This one's from Instagram. This is state specific. Can I have a trust that contains multiple businesses and then keep the business assets in their respective LLC? I'm in Delaware.
Okay, absolutely. So if we go back here to the trifecta, one of the prior ones, let's go back up here. So you can have your trust down here, and again, it would own your home. It could own your LLC, and it could own hundreds of LLCs. It could own your operating business, whether that's an LLC, a C Corp, an S Corp. Generally, we're going to use S corporations over here for clients, or LLCs taxed as S Corp. You could have a partnership over here on this side where you have your business operations. But absolutely, the trust is going to own these entities. Now, I want to make, and this is probably a good transitionary point to talk about trusts. Trusts can be used for asset protection, but we think it's overdone. So let's go down here and go over the different types of trusts you can use. So in the trust world and in asset protection, you're going to hear lots of different trusts thrown out. So we've got the Revocable Living Trust, the RLT, Domestic Asset Protection Trust, or DAPT, the Irrevocable Trust, the Foreign Trust, and the Land Trust. Okay, these are 5 different types of trusts you'll see out there in asset protection planning. The 2 that we like in our law firm, and the 2 that really true high net worth people use, not the people talking about trust and selling asset protection strategies on YouTube. I'm talking like real lawyers helping real clients that have real net worth. These 2, Revocable Living Trust and Domestic Asset Protection Trust. Sometimes it's an irrevocable trust, but frankly, that's more for estate tax issues for people with a 20 million plus estate than it is people that are trying to use it for asset protection. But there can be some asset protection benefits to an irrevocable trust. The problem is it has tax baggage. So let's walk through each of those 5 different trusts and how it can help you in your asset protection. The first is the Revocable Living Trust. This is just your regular family living trust that says, when I die, here's who gets my assets. Now, there is no asset protection in and of itself in a revocable living trust. If I get sued and my assets are in a revocable living trust, there is no protection like an LLC. They can go right through the trust to me and to any other assets I have. So if I just own a business in my revocable living trust and something happens, there's zero asset protection. It is not like an LLC or corporation where that liability gets contained there. They can get all your assets in your personal name, the other assets in your trust. So the revocable living trust does not have this corporate veil or limited liability protection like an LLC has. What it does have, though, is the ability to be more private. So for example, you can put assets in the name of the revocable living trust, and you might name your revocable living trust the XYZ Trust, okay? The MNS Trust, the ABC Trust, the Greenbrier Trust, whatever you want to call call it. I had a client name all their entities in trust after Born Identity, all the code names for all the covert programs. Anyways, so whatever you want to call the trust, put it in that name. And so there's some privacy to that. That's different from asset protection, but it does help you maintain some privacy with your assets by using a trust. Now, in some assets, you have to list the trustee of that. And so if it's you, your name could be on some of these documents, but there's a little bit of benefit of privacy using a revocable living trust. The second type of trust that we like to use for asset protection is ADAPT. ADAPT is called a domestic asset protection trust. And in a domestic asset protection trust, what happens is you put all of your assets into it. So let's go down here to the DAPT, and we're still gonna do a revocable living trust, by the way. Now the DAPT is typically gonna own your entities. It could even own your S Corp, okay? It's gonna own your entities here. Now, the Domestic Asset Protection Trust is in about 17 states that have it. That's Utah, Nevada, Wyoming, Tennessee, Hawaii, Ohio, Oklahoma, New Hampshire, Indiana, Virginia, Missouri, Montana, Mississippi, Alabama, Alaska. Okay, there's a few I might have missed there, but there's 17 states that have this domestic asset protection trust. Now, what the laws say in these states in general, there's some variation amongst them, but in general, what the laws say is if there's a lawsuit and someone's trying to collect, they are restricted from getting into any assets held by the domestic asset protection trust, period. We had a client that had a domestic asset protection trust in Nevada, and they had a judgment against them personally. Okay, this client had a judgment against them personally for over $600,000. Now, in that case, what happened is they had a bank account actually at Wells Fargo, and this is in Nevada, that was in the name of the Domestic Asset Protection Trust. That bank account had millions of dollars in it. A garnishment order went from the lawyers of the person that had the judgment against them, our client, and said, hey, Wells Fargo, we have this valid judgment against this person in their name. We want you to distribute the money and we're going to garnish the money out of the bank account. Well, Wells Fargo, when we got notice that, because you get notice on these when they send a garnishment or try to collect on your assets as the debtor on the other side of this, you get notice. We immediately contacted the bank, talked to the bankers, sent them copies of the trust, made sure they knew this bank account was actually owned by a domestic asset protection trust. A couple weeks went by, went through the legal rigmarole at Wells Fargo. They ended up not distributing any funds out of that account and not recognizing the garnishment because Nevada had a domestic asset protection trust law. The client used the domestic asset protection trust, and that creditor was stopped from getting any of the assets that domestic asset protection trust owned. This could be brokerage accounts, this could be cash, any of those accounts that were connected to the DAP were protected. So that's in essence how the DAPT works. Now, let's say you're in California. You can't use ADAPT. Maybe you could use it on assets you have in those states that have a domestic asset protection trust, but the DAPT is not going to work for your California-based assets if you're a California resident. So this works best for people who are residents of a state that allows for DAPT, or you have assets in that state, significant assets where you could use ADAPT, taking advantage of the assets that are in that state. Now, this is an unlimited amount of protection. Now, the cool thing about the DAPT that is different than some of these other trusts that we don't like is it is considered a disregarded entity self-settled trust for tax purposes, which means you do not file a trust tax return. It's the trust is there just like your revocable living trust. It does not exist for tax purposes. You do nothing differently with the IRS. Even though that legal structure is there giving you asset protection, it does not affect your tax planning or jack it up. Some of these other trusts I'm going to talk about here in a second can give you asset protection, but you're volunteering to pay more to the IRS in taxes to have them, and you're going to have to file a lot more disclosure documents and have a lot of annual costs to maintain them. So we don't like them for that, but the DAPT might cost you a couple $1,000 to set up and maybe $500 a year or so to maintain. But after that, it's a pretty sweet structure because you have the asset protection. It does not jack up your tax planning, and it gives you an unlimited type of asset protection for your assets. Now let's bounce back. I want to beat up some of these trusts that we don't like. I want to tell you why. The next one is the irrevocable trust. Now I mentioned this earlier. You can use an irrevocable trust and an irrevocable trust basically means you put assets in it and you say, I can't move these assets out. I can have rights to the income from it during my lifetime, but I can't move them out. And when I die, XYZ person gets it. My family, a charity, my heirs, whoever it may be. And it's irrevocable. I cannot change the terms of it. There is some asset protection benefits to an irrevocable trust where creditors would not be able to get at assets owned in an irrevocable trust. However, those assets are locked up. You can't leverage those assets with other stuff in your personal name. You are entitled to income from it. You have to have a separate trustee from yourself managing those assets. That's a cost and a constraint in just doing business and operating and holding your assets and making the changes you want to make. And so an irrevocable trust can work, but it is expensive and it's going to cost you taxes because you're going to have to do a trust tax return, which is the highest tax rate, by the way. So you're automatically subjecting yourself to the highest taxes on on very low dollar amounts, as opposed to the individual tax rate, which is stepped schedule, So the trust tax rate is stepped as well. You just get to the higher tax rates faster. Now, the reason some people with very large estates that have 20 million of assets or more will use irrevocable trusts is not really for asset protection. It's for estate tax planning and gifting assets over time. And that's basically a strategy to gift away your estate during your lifetime to your family members to reduce your estate tax burden. If you have an estate worth, 20 million plus as a married couple, you can run into estate tax when you pass away. It's maybe at 24 million or 25 million now. But in general, I'm just saying 20 million. And what happens when that estate passes and you have that large of estate at the federal level, you have almost a 50% tax. So if you have a $25 million estate that's subjected to estate tax, and let me clarify that. Actually, it's the amount over the exemption here of 20 million. So let's say you had a $50 million estate. You have an exemption really of the first 25 million approximately right now. So that other 25 million would be subject to estate tax. The problem is that estate tax is 50%. So it's 50% of that 25 million over the first 25 million. That's 12.5 million of estate tax. So some people use an irrevocable trust to gift that amount away during their lifetime so that they stay under the 25 million. So irrevocable trusts are sometimes used for that. They might be used for irrevocable life insurance trusts. Charitable remainder trusts are good strategies. That's a tax planning strategy that can have some asset protection. But we just don't like just a blanket asset protection irrevocable trust. We like to use it for more tax planning than we do just for asset protection plan. Now, the next type of trust, a foreign trust. If you're doing foreign trust like in the Cook Islands or these other jurisdictions that have trusts that people have used as asset protection havens, quote unquote, you better make sure you're willing to pay tens of thousands of dollars a year in legal fees to maintain that, and maybe $5,000 or so in accounting fees to do all the disclosures for the foreign bank accounts and the foreign asset reporting you need to do the IRS. Foreign trusts, I have to say from my experience, the clients that have benefited from asset protection that have done foreign trusts over the years, and we don't do them, we refer them out if someone really wants them. But from my experience, I've seen more chaos for clients in their tax reporting, forgetting to report stuff to the IRS or paying exorbitant fees to maintain them than I've seen clients actually benefit from the asset protection benefits. So, and foreign trusts are defeated a lot still. It's very hard to get assets if you have a judgment. So what a lot of people will say is, all right, I'm going to do a foreign trust. I'm going to put all my assets in this trust in the Cook Islands. Then when someone has a judgment against me, I'm going to say, good luck collecting it. You got to go to the Cook Islands and the courts in the Cook Islands to go collect on it. And those courts are very debtor friendly. They don't let you get into the assets in the trust in the Cook Islands. Well, that's great. What if you need to get assets over here to use in the US because you actually want to live on the assets or benefit from the assets or invest in something in the US, a new business, a new piece of real estate, whatever it may be? Well, you're screwed. You're not getting it out of that foreign trust if you got a judgment sitting against you. So it's not defeating any creditors. It's simply delaying them, but it's also going to force your hand at some point because you're not going to be able to get the assets out of that trust to use them So just be wary of what you're really getting with some of these trust structures. The foreign trust being one that I think is oversold. You have to be a very high net worth person to even consider it. And even then, from my experience, even clients that are very high net worth that have used them, I've seen very little benefit from the asset protection, but I've seen many of them pay a lot in fees, and some of them screw up their tax reporting to the IRS, which is not a place you want to be. Foreign assets and foreign bank accounts and failing to disclose those or forgetting to do it or changing accountants and the word doesn't get passed along, that's not a place you want to be at the IRS, okay? But the last one is land trusts. Land trusts are a structure that is basically just a trust. It's a revocable living trust. But some states, like Florida and Illinois, actually have a statute that says assets in the land trust are protected from creditors, kind of like an LLC. Okay, something happens in it, the creditor's stuck in the land trust, they can't get down to you personally or your other assets. The problem is people try to use those in all other 48 states, and that doesn't work. Don't use a land trust in Arizona. I had a client that had a land trust that owned a property worth a couple $1 million. They went to go sell it, and guess what? They couldn't sell it because the title company said, what the hell is this? Arizona doesn't have a land trust statute. What are you using? Well, I went to some real estate investor event and someone sold me a land trust for asset protection. And the guy lived in California even, which doesn't recognize land trusts either. They might have a business trust they'll recognize from a tax standpoint, but transacting with land trusts can be complicated. I don't recommend it for asset protection, maybe for privacy, where you're just kind of using the trust like your revocable living trust, but I'd be wary of using land trusts in states that don't have a land trust statute. Now, I know out there, a lot of people use them. There's a lot of people who sell land trusts and preach about how great they are. That's because they sell them. I'm telling you, if you go to large law firms that are representing real estate investors, people that have big real estate portfolios, they are not using land trusts. They're not. They're using LLCs. You know who the only people using land trusts are? People that get sold them at a Holiday Inn at a real estate investor event. That's the people using land trusts. We just don't believe in them. Granted, you could use them in Florida or Illinois or states that have a land trust statute. There's very few. But for the other 48 states, we don't use them or recommend them for clients because all they are is a revocable living trust in those states that can get blown right through. So watch out for land trusts. Be careful of those. You could use them for privacy. I could see a benefit there, just like a revocable living trust like I talked about earlier for your home. But that's all it is. Don't use it instead of an LLC. You would still use an LLC to get the true asset protection.
Hope you found value in that video and took something away from there that can help you on your wealth building journey. Make sure you're subscribed though to the channel because I got tons of information I want to share with you to make it easier, faster to build wealth. We'll see you next time.